So, just how low could stocks really go during this market turnaround? Well, the answer might surprise you. What's up, guys? I'm Nobody Special, and we're trying to figure out today just how low stocks might actually be able to go this time around because we've already dropped quite a bit in the S&P 500 this year, down 22% year to date. And a lot of people are saying maybe the worst is behind us. But as you look in the numbers, you'll see that is definitely not the case. Now, to understand just how low stocks could go, you have to understand what people are talking about when they typically say stocks are expensive or stocks are cheap. They're referring to the PE ratio, or the price to earnings ratio, sometimes referred to as the multiple. And when you hear people talking about the average PE ratio for the S&P 500, you might hear them refer to it as a market multiple. And that's pretty simple. That's calculated based on taking the stock price divided by the earnings per share. That gives you the PE ratio. In the case of the S&P 500, we're talking about the average stock price of the S&P 500 divided by the average earnings per share in the S&P 500 gives you the S&P's PE ratio, or the market multiple. And with that, we are going to shrink my big melon of a head, and let's take a look at some charts. This is the S&P 500 PE ratio going all the way back to the 1800s. Now, you can see right now we're at a PE of about 18.93. We'll round that to 19. You can see the PE ratio of the S&P 500 has actually come down considerably just in the last few months. We were as high as the mid-30s not too long ago, but still historically, this market is considered expensive. We're trading at a much higher multiple than the market has historically traded at. The historical average was actually closer to around 16. Now, if you look at that, okay, the market could head a little bit lower, but not that much lower. And just take a look at this chart of the S&P 500. This is the year-to-date chart of the S&P. We started the year around 4,700, now down around 3,700. So we've seen a drop of 22% year to date in the S&P 500. Maybe the worst is behind us, right? Not really, because you have to realize what most people consider the best gauge of how expensive the market is something called the Shiller PE ratio. And this was invented by a Nobel Prize winning economist named Robert Shiller. His name is on a lot of really good work. And what he does is he takes the S&P 500, but he calculates the PE ratio using the E column. He takes the average of the last 10 years of earnings of the S&P 500. And when he does that, he's able to smooth out the cyclical bumps caused by swings in the market. And when you look at the Shiller PE ratio, the average of the last 10 years earnings, you get a much different picture of just how expensive this stock market really is, because we're currently trading at a Shiller PE of 28.93. Again, we're down off our highs, but historically, way overbought, way expensive compared to where we've historically been. Just how expensive? Well, folks, if you take away this bump from the dot-com bubble, which was just la-la land, and you look at where we were even at the start of the global financial crisis, right? Before the Bear Stearns collapse, before Lehman Brothers, we were at a Shiller PE of about 26. So right now, even after falling 22% year to date, our stock market is still more expensive than it was at the high before the global financial crisis. So how low could stocks really go from here? Well, if you look at where we could go, folks, just taking the low from 2009, the Shiller PE dropped to 15. We're currently at 28.93. That implies a downside of almost 50% from where we're currently trading at, folks. Which means if no changes to earnings were to happen, if just the Shiller PE were to drop to where it was at the bottom in the GFC, we're looking at an S&P 500 below 2,000. You can see that's a pretty far drop from where we're currently at. And remember, folks, right now, all we're talking about is changes in the multiple, changes in the PE ratio, the price to earnings. And if the multiple comes down and the earnings stay the same, well, that would mean the P, the price of the stock, were to come down with it. But what happens if the earnings are to drop? You see, if the E starts going down in the P to E ratio, that would drive the multiple higher. But people are not willing to trade higher multiples when earnings are in decline, so the price tends to drop even harder. Well, if you look at this chart right here, this is the S&P 500's earnings going back the last couple of years. You can see, folks, where we're at right now. The S&P 500 earnings, on average, have not even begun to decline. All this 22% drop in the S&P 500 over the last 6 months has all just been multiple contraction. This has been the market anticipating future earnings declines caused by the Fed rate hikes and the downturn in the cycle. But that hasn't even begun to materialize yet. This is going all the way back to 2018. Folks, you can see here since the start of 2022, earnings have just traded sideways. All right. Stock earnings have not even begun to fall on average. Some earnings have come down, some have come up, but they're still moving sideways. This is going to start declining very soon. And when the earnings start declining, remember the P to E ratio, that would drive the multiple higher, but people don't pay higher multiples for companies in decline. So it's going to drag the price down even harder. So all those talks about potentially 50% downside from here and the PEs correcting to where they were at the bottom of the global financial crisis, those were all talking about earnings staying the same, just multiple contractions. If the earnings drop, there could be even more downside than that. So long story short, folks, how much further could stocks drop? The answer is a whole heck of a lot further than they've already dropped. Even after this 22% decline in the S&P 500 year to date, earnings in the S&P have not even budged, and we're still at a multiple that's even higher than at the start of the global financial crisis back in 2007, 2008. So between the prospect of price to earnings ratios coming down substantially and the likelihood that earnings drops even further, folks, stocks could go much, much lower than they're currently at. Don't think just because you've gotten used to these higher prices of the last 10 years that it's always going to be that way, all right? That is normalcy bias. Don't let normalcy bias convince you that stocks can't go any lower. Stocks can go much, much lower from here. And if the Fed keeps tightening, it's exactly what's going to happen. So how low do you think the S&P could go? I'm saying we're going below 2,000 at some point. Let me know down in the comments what your opinion is of how low this market could go. Till next time, live small and dream big.